Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week we were discussing the S&P 500 and talking about an earnings blackout, which is, I suppose, a trading blackout where companies can't actually buy back their shares in the closed period in which they find themselves. And I know that you want to pick up again on that subject today because, in fact, US earnings season is kicking off. We had Alcoa's results last night, but I know you want to look at the chart specifically with reference to this blackout.
Yes, that's right. So we often do this. We look at the S&P 500 chart just to sort of sketch the bigger picture. But I'm also going to flesh it out more this week. We're also going to look at the Russell 2000, and we're also going to look at the Nasdaq as well. But let's start with the S&P 500 just to update ourselves there. And little has changed from last week when we spoke about this chart. The downtrend from the July highs of last year still comes in at about 2080. And we saw the market moving up to that level about 2 weeks ago. It so far seems to be struggling at that resistance level. And there has been evidence of selling pressure up at the higher levels each day on the market since then. So it does appear that that resistance area is holding for now. And as you mentioned, we've gone into US earnings season. Just on this chart, another thing before I carry on is that we've spoken before about this double bottom, which was at about 1810 on the S&P 500. When that market broke out through that high point there, which is at about 1940 odd, that opened up the higher projection of 2080, and we've got to that target now. So what I'm saying is that this market does appear for now as if it seems to be stalling in terms of its upward momentum. You can also see on your RSI up there that's begun to turn down, and then your stochastic oscillator here also had been making negative divergence over the last few weeks, and it's begun to turn down now. So that all sort of points to a bit of softness in the US market. And I'm not saying it's all going to fall down in a heap, because I simply don't know. But you take the technicals as we've got them here, and then also that blackout period. And what that blackout period is really is that in between quarter end and when companies publish their results, that's called a blackout period. And during that time, directors of, and I'm talking specifically US companies now, but it's pretty much a global law as well. Directors are not allowed to trade in the company's stock, and the companies themselves are not allowed to do any share buybacks during that time either. Now, what has been happening a lot on the US markets recently have been share buybacks, where companies buy back their own stock in order to reduce the number of shares in issue, and that indirectly enhances the earnings per share. But now they can't do that. And what we've seen in the past is that during these blackout periods, and it can last sort of from, say, 4 to 6 weeks. Essentially, it's from the end of March, the end of the quarter, up until when the companies publish their results. And I think it's for 48 hours after the results have been published as well. They're not allowed to trade in the company's stock. But thereafter, they're then obviously free to do so again. So if you remove that element of demand from the market that has been there for a while, that does sort of suggest that we could be in a time where we might see a bit of softening on the US markets. And as I say, I'm not calling for it to all fall in a heap. I mean, you might find very much that we see something like at the end of October over here, where the market just sort of churned around and didn't go up, didn't really go down significantly either. It was just a choppy, generally a bit of a frustrating environment.
What about, now the S&P is not necessarily the broader market, whereas the Russell 2000 is, and in fact, we hardly ever talk about the Russell 2000, but it tracks the smaller and mid-cap shares on the US markets. Is there and it would be interesting to see the difference between the Russell 2000 and the S&P 500, because I imagine it might be quite similar to the South African market. We've had a couple of shares hoist us higher, but the small and mid-cap stocks, a lot of them have been battling.
Well, that's absolutely right. And that's why I wanted to bring in the Russell 2000 chart here, just to give a little bit more color to the whole US markets as we see them, because we always look at the S&P 500, and that's one measure of the US markets, but it is the 500 largest stocks in the US, and it is quite heavily skewed towards some stocks that have a very heavy weighting in that index. So, you don't necessarily get a clear picture of the overall US market. Now, the Russell 2000 is the sort of the small cap area of the US market. It's made up of 2,000 shares, as the name would suggest, and they're generally all small and mid-cap shares. I think the largest company in the Russell 2000 has a market capitalization of something like $5 billion. So, you know, sizable by our standards, but in the US markets, that's not that massive. And so you're talking about the sort of the bottom end of the market here, but when you talk about market breadth, you would find that this Russell 2000 includes a lot more shares and does give you maybe a better accurate indication of what's happening at the lower end of the market, as opposed to the S&P 500,
sure,
which looks only at the upper end of the market. So if we have a look at the Russell 2000 chart, you can see that it's not looking as strong as what the S&P 500 has. You'll recall from that previous chart of the S&P 500 that it was not that far away from its all-time highs. The S&P now is within about 4% of its prior top. So it hasn't come down very much. The Russell 2000, on the other hand, if you have a look at it, even after this big rally that we've seen since the middle of February, the Russell 2000 is still about 13% below its July high of last year.
Okay.
So that kind of puts it into perspective for you. And you can see here there is still this downtrend evident on the Russell 2000 here. And that downtrend area is not far away from where the market is now, and it corresponds with the underside of the 200-day moving average for the Russell 2000 as well. So it's just worthwhile noting. And again, similar to what we saw in the S&P, your RSI has been making negative divergence here, and your stochastic has also been making negative divergence recently, which is an indication that the upward momentum of this rally that we've seen over the last sort of 7 or 8 weeks is now beginning to run out of momentum.
Yeah. And what about the Nasdaq, Garth? Because,
so this is the Nasdaq 100 now. So it's actually the top 100 stocks within the Nasdaq. And what I really want to point out here is that we've also had a very powerful rally since the beginning of February, as we saw with the other two US indices. But we've now reached a point at around about 4,500 on the Nasdaq, where there is some resistance over here. You can see that resistance is demarcated by the November and December lows of last year over there. So when that market broke down below that point, that was sort of a bearish break. We've now seen a rally back up to test the underside of that resistance. And again, you've got your negative divergence evident over here on the stochastic, and on the RSI, it's also begun to sort of roll over. So once again, indications that the momentum of this move upwards is starting to slow down, and we can expect maybe a bit of a period of softness for the US markets here.
Okay, taking us back home and teeing us up for the trade that you've enacted this week. What's happening to the top 40 at the moment?
Yeah, so it's interesting because my trade this week, funnily enough, is a long on the top 40. And you might look at all of those last 3 charts and say, what on earth are you doing? You know, you've just told us that the US markets are not looking that great, and now you're going long on the top 40, so it doesn't really add up. So hear me out. I'm just going to explain why. And also do keep in mind that the context of this is also with the knowledge that I've got that options structure in the background, which we've spoken about before on the show. And I guess me going long here is sort of preempting the possibility that if the market moves higher, then I want to have some degree of comfort by being long against an option structure, which could start losing me money if the market really rallies.
Yeah, okay.
So let's just have a look and unpack the technicals quickly while we're here. So this is the chart of the top 40, as I mentioned. What's quite interesting to note here is that we've had this pullback since late March. Probably last 2-3 weeks or so, it's been pulling back gradually. And here you've got your 50% retracement of that move. So what I mean by that is you take a measurement from that bottom in late February to that high in mid-March, and then you measure that total distance of that rally, and then you measure 50% retracement of that and 61% retracement of that. Those are very common Fibonacci numbers that we look at often. And very often, if you've got a trend that's going, rising or declining for that matter, but in this case, a market that's rising, you'll often get a retracement back into that 50% or 61.8% Fibonacci zone. And that often is where you might find some support begins to emerge. Now, what's clear here is that the market's pulled back to that 50% retracement. That also corresponds with the 50-day moving average, which is that line over there. Yeah. And we've also got the 200-day moving average in a similar sort of an area as well. At the same time, we've got very oversold stochastic oscillator over here. So that to me sort of suggests we might be potentially lining up a bit of a bounce here. And if you zoom in on the more recent trading action over the last week or so, which I'm going to do now, you can see that our market has been forming a bit of a base, and today it's actually started to break up through the top of the base formation, if you like.
Yeah, I mean, I was going to say, last week was quite frustrating because actually we kind of didn't go anywhere, even though there was sort of moves within the various indices that I guess then would contribute to the top 40. But today, finally, the market seems to be running.
Well, this is it. So here I've got a chart of the June Aussie future. So this is the top 40 futures contract, which runs out to the middle of June. It's a 1-hour chart that I'm looking at here. So every candlestick pattern on this graph represents 1 hour's worth of trade. And it goes back to about the 3rd week of March over here. So about 2-3 weeks worth of trade, I guess. What's notable is that we've got this downtrend, which goes back to that high from the 21st of March, comes all the way through the highs that we've seen over the last couple of weeks. But now notice that the market's begun to move above that downtrend, which is the first sort of sign of it's an encouraging sign. But also, this top 40 future has been very range bound, within a range of 45,400 to 46,000 over the last week. So, I mean, this goes back to last Tuesday when we were last sitting here. Till now, it's been chopping along sideways in this range. And it's been a frustrating range, as you pointed out, with making it difficult to trade. But today, we've begun to see the market move out above that 46,000 resistance. And that, to me, suggests that we've now got this base in place, and the market looks as if it could probably move higher from here. And if I take the height of that range and project that up, it gives us a move of 600 points in the direction of the break. So it takes us to about 46,600. But what I also want to note here is these gaps on the top 40 future. There's one over there at about 46,300 or so, and there's another one higher up at about 46,700. Those gaps will probably be targeted on this move higher.
In other words, looking to close those gaps.
Yeah, looking to close those gaps.
Okay, got. So taking all this into account, maybe sketch us through the long position that you've taken.
All right, so I've gone long based on the fact that the market has begun to break out through this 46,000 resistance area. I've gone long at 46,008, and I've gone long of one top 40 futures contract. My stop loss is going to be below these lows of the last few days, so it's 45,550. That's where that red line is. If the market starts to take out those lows, then I'll have to exit this trade and concede that I was wrong. And that means that my risk here is 4,580 Rand. So in percentage terms, relative to the capital that we've got at our disposal, it's about 1.8% of capital that we stand to risk here. And I mentioned previously that the option structure is also in the back of my mind here, and our regular viewers will have seen that option structure. We spoke about it a little bit last week on the show, but you can always review past shows on the internet to go and have a look. If the market starts to break out through 47,000 here, which is where my cursor is there, my option structure will begin to lose money at that point. And then it's effectively like being naked short from that point on, which is not what I intended at all when I went into that
the option
trade.
structure was supposed to be, it was built to give you some sort of peace of mind, and yet unfortunately it's turned into the opposite. It
has turned into the opposite, and it's because the market's been a lot stronger throughout the first quarter of this year than what I had anticipated it to be. So it has surprised on the upside. Now, the problem is if we continue to move higher, I don't want to sit with that, what is essentially going to become a naked short position as the market rises, and then we'll start to lose money. So being long of a top 40 future here essentially will neutralize any gains that we see whereby that option structure might start to lose us money. I know it's quite complex, but for all intents and purposes, I'm long, and I can make money on this. If I include the option structure, I can make money all the way up to 47,000, and thereafter my profits will be capped.
Okay.
And
in fact, you'll probably end up in a net neutral position, because if it starts to fall, then you'll have to buy it back.
Yeah, then I'd have to close this long position out. Yeah.
Okay, so taking that all into account, what does the portfolio look like, Garth?
The portfolio looks like this. So we've still got our long position in life healthcare that we have had for a number of weeks now. Slightly in the profit there, very frustrating, but we're still hanging in there. There's the option structure that I've spoken about. And now this June futures contract that I've gone long of today, 46,008. I'm up 1,000. Well, when I did these slides, I was up 1,000 Rand on it. So actually, we've gone into the black for the year to date. Can you believe it? We're up 0.3% for the year to date, back above our starting capital, which is encouraging.
Yeah, at least a dinner at the Spur. Garth, very quickly, next courses.
Yeah, so I've got courses coming up in May in Johannesburg and in Cape Town. I'll be running CFDs courses and high probability trading courses. And then my colleague Andrew Todd runs a top 40 futures trading course, and that's on the 7th of May in Cape Town. So anybody that would be interested in attending attending any of these courses, please send me an email, garth@traderscorner.co.za, and I'll respond with the necessary details.
Okay, great, Garth. We have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.